Welcome. My name is Alvaro. I'll present a perspective on our economy in its current state and its potential demise, maybe. What I mean is, I'm referring to a situation where our economy's stability, based on the US dollar, could go in two different directions. I'll give you some background information before getting to our economy's specifics. So, one way to measure our economy's performance is through gross domestic product, GDP. My economics textbook, Principles of Economics 6th edition, defines GDP as the market value of all final goods and services produced within a country given a period of time. The textbook states the formula for GDP as Y equals C plus I plus G plus NX. Y stands for GDP, C stands for consumption of the people, I stands for investments, G stands for consumption of the government, and NX stands for net exports. Each one of these variables has a relation to our currency. They all involve an exchange with currency, whether it be with goods, investment options, exporting or importing. The bottom line with this is that our dollar contains such a strong influence in how our economy is performing. So the question is, what could affect this? What could cause our dollar to collapse? A fundamental weakness is a trigger in most cases. TheBalance.com is an economic website that has an article which explains some very important potential weaknesses. This can include a weak US dollar declining compared to other currencies, an increasing debt to GDP ratio, or an alternative to holding dollars such as gold. A declining US dollar is often a sign of other large factors compiling to this effect, such as unemployment, inflation, or liquidating of domestic assets. Liquidating of assets just means selling for cash. An increasing debt can further worsen our dollar's value. Foreigners could lose confidence in holding investments, and countries invested in our stock market can pull out of their investments. This would cause them to lose value and prices could plummet. I'll explain later technically how this works. According to Statista.com, which compiles statistics based on over 22,500 sources, the US debt to GDP ratio is 108.14%. This means that our debt is greater than our GDP, and our debt has only been growing. Between 2002 to 2012, our debt has tripled, nearly tripled, from 6 trillion to 15 trillion. Especially during market crashes, and so how can we repay this? Yet, the US dollar can print more money, but this would result in our debt being paid with cheaper dollars. So, how can this affect the dollar? Well, during a market crash, our economy takes a hit. As price levels of assets drastically begin to stray from normal fluctuations, panic selling and institutional liquidating drag these levels down even further. Well, with invested money being pulled out of domestic assets and a failing dollar, investment banks, portfolio managers, and investors would have to hedge against this to prevent their capital from losing value. To hedge or prevent capital losses, money would simply be have to put in other assets. Here's a graph of the S&P 500 during the 2008-2009 market crash, right over here. So, it had a really strong decline that basically backtracked all of this progress and took several years to catch up. Same thing happened to the Dow Jones around the same time period. These are indices. An index is used to track certain stocks in a stock market. There are thousands and thousands of stocks of also different international markets too, and it's very difficult to keep track of their each individual performance. So, for example, the S&P 500, this index tracks the top 500 largest companies based on market cap. NASDAQ and NYSE are exchanges that have all of these stocks compiled. So, and now we look at this graph, which shows the exchange rate between the Japanese yen, and the US dollar. So what this means is you'd exchange one Japanese yen for one US dollar at this price. So around the same time period, there was a small dip which was actually corrected during the market crash. Overall, the Japanese yen accumulated value against the US dollar. This is a graph of gold. So around the same time period, panic selling, liquidating, caused gold to drop. But there was some buying pressure because they had to hedge their profits or their gains, and gold went up a little bit, but overall it went down during the crash. This is a graph of the DXY. It is a currency index that tracks the US dollar based on other world currencies, such as the euro, Japanese yen, Canadian dollar, British pound, Swedish krona, and the Swiss franc. Overall, the US dollar crashed around this 2008-2009 crash over here, and then settled down. This is where confidence is clearly shown that people lost confidence in the US dollar, abandoning their assets. Confidence is the most important factor in a crash. I'll discuss the current outlook of the current US dollar, but first, let's see what the news says. American prosperity shines bright, but economy needs strong growth. America's economy is back and roaring, and its people are winning. US economy starting to rock. Trade spat to dull expected tax cut boost to US economy. So, the overall outlook is that we have a healthy economy. But now, let's take a look at the current outlook of the US dollar based on more fundamentals. This is a line chart that shows the change in GDP growth. And according to the Bureau of Economic Analysis, the annualized Q4 2017 GDP growth rate, not GDP, but the growth rate, was 2.9%. This beat market expectations by 2.7%. The average GDP growth rate over the past 5 years was approximately 2.2%. So, it's good news. According to the Financial Times news organization, the yield percentage for 10-year US Treasury bonds had been rising recently. We can see this since 2016. So we can gauge several factors of our economy using bonds and their yield. Bond yields are essentially the percentage return on your investment after holding them for a certain amount of time. So for 10-year Treasury bonds, you would pay cash in exchange for a bond that will give you a certain percentage return after 10 years. According to Investopedia.com and various sources, generally when bond percentage yield rises, prices for the actual bonds fall because they are not in demand. This is mostly due to the money being allocated in an optimistic stock market. So when there is fear of a market crash, people pull out of stocks, bond prices increase, and their yield decreases. So with our current rising bond yields, as we can see, this indicates an optimism for the stock market. So we can also see that labor markets are doing good, employment is rising. We can also see that interest rates are low. So the effect of interest rates is that they're like a ripple effect. According to Investopedia.com, when interest rates rise, it becomes more expensive to borrow money. Consumers are affected mostly through credit and mortgage rates the most. As a result, for consumers, consumption decreases. As for companies, this can reduce the revenues as well due to less consumption. This can also increase companies' debt expenses from the interest rate itself. Furthermore, this causes stock prices to decrease and investments to drop. Well, these are two factors that affect the GDP equation, as we can see. If consumption decreases and investment decreases, GDP should decrease. A weak GDP can also be very representative of a declining dollar. So I can present to you more fundamental data on our economy as an outlook for the dollar, but that's not the fun part. These are statistics based on our data. These are statistics based on data of our current economy. What I'll present to you now is data based on the dollar itself. First, some background information. Technical analysis is a very broad term. It is essentially the use of trading activities such as price movement, volume, or other analytical tools to assess and forecast future price movement. The Dow theory is a very strong support for technical analysis because in the finance world, it is often argued that the past does not predict the future. But to contrast this, history does repeat itself, like business cycles. Technical analysis of price theory, price history based off charts can give a good idea of future projections, whereas fundamental values only tell you what is currently happening, not what could be forecasted. The Dow theory, as mentioned, disregards fundamental data and news affecting market prices. It states that these news is already accounted into the current price. Here are some examples. I'll begin with interest rates. So, at 10 a.m. last Wednesday, economic news came out for the Canadian dollar. Interest rates did not change. So, what happened to the price? As we can see, at that exact time, 10 a.m., the Canadian dollar lost a lot of value to Japan in a short period of time. Here is an example with USD CAD. Another pair that was exchange rate was also affected. Now, I don't know why fundamentally this happened, but the chart shows that this news doesn't really correlate with what happened to the actual exchange rate. Here's the British pound exchange rate with the Japanese yen. So, same thing happened here. Exchange rate did not change, but there was a sharp increase in price in such a short period of time, which was eventually corrected. Fundamentals cannot explain this, but technicals can. So I'll begin with support and resistance, which is essentially supply and demand of price. When I say price, I'm literally referring to the price of buying or selling dollars and exchange rates. So this blue line is representative of price in the chart. Support is demand. So banks, hedge funds, large investment firms, they all have lots of money, millions, billions. When they place these large orders in the market, for example, if they buy, this is what's known as support levels. The orders fill up all the sell orders and price goes up. That's support. Resistance is when there's a lot of sell orders pushing price down. So price can go up and down like this, which is known as consolidation. There's no actual trend, no movement. You can't forecast this. So this is a very simple representation of it. Whereas here we can clearly see an uptrend. There's more buying volume overall because we're making higher highs and higher lows. So this is a chart of the DXY dollar index of the US dollar. And we can see that this is what's known as a naked chart. There is no analysis into it, but we're clearly in a decline. With technical analysis, we can see that we have a trend line which is respected. Trend line is essentially a diagonal version of support and resistance zones. So over here, this is slightly known as consolidation, where there is not direct movement, but price has an accurate zone here, an accurate zone here, where it just keeps rejecting buy orders, and then once it breaks, all the sell orders take charge. Right now, we're in a very critical area where if we break below this, sell orders could do its panic selling, liquidate all the used assets, and could be a potential crash. So that's how close we are. Is it possible for the dollar to collapse with our current status? We've seen the fundamentals and the technicals. The short answer is no. According to thebalance.com, China owns $1 trillion in US Treasury bonds. Japan owns more than $1 trillion in treasuries. These companies would probably only dump if their dollar holdings begin to lose value very quickly. Panic selling. These countries also have large markets dependent on US consumers. So if US dollars fail, then the value of their dollars would also be affected. Countries that have the power to make a currency fail simply rely too much on US exports. Also, with low interest rates as we have today, it's even less expected for the dollar to fail. However, the answer can also be yes. Who's to say that these countries won't abandon the US dollar? What's to stop the market crash from causing this? Look how close we are to this happening. We're at the point where all it takes is one potential crisis and our dollar could shift its outlook. Thank you.